out there and save some money. We talked about that yesterday. Number two, you could sell something. If you don't have enough money to come up with investing, $20,000, $30,000, whatever you need for your strategy, maybe you could sell, maybe how many people have a spare lounge or spare boat, spare car, spare furniture, spare spouse, spare kid, whatever it is. Cash it in. Cash it in, okay? And use that money to invest. Do whatever it takes in the short term. Now, if you're sitting next to your partner, it's not a good idea to go, oh, that's a good idea. No, that one down. Number three is tax. Many of you are paying too much in tax. You would have heard Warren speak last night. Speak to the accountants. Get your tax organized, how to minimize your tax. The good thing is many of you are becoming investors. If you're not already, that will take care of a lot of your tax by being an investor. Number four is, income. Go to work on increasing your income. Okay, one of those home studies, I mean, they're giving away, I think I would have mentioned on the video before, sales and marketing, $1 million sales and marketing, you know, normally $500, you can get them for $95. Skill sets like this, public speaking home study, all these type of skill sets to improve your income. If you want to say to me, Jamie, how do I increase my income rapidly? Marketing. Study marketing. Not a uni degree, but actual real-life marketing skills. Because if you work for a company, if you understand marketing, you can increase that company's profitability and you can take a slice of that, or it's your own business. So there's things you can get those skill sets: negotiation, marketing, problem solving, communication. All those skill sets will improve your income. You'll be able to add more value to your boss. Number five is OPM, stands for what? Other people's money. So let's say you didn't have any money, but you got a $40,000 personal loan. I'm not saying do this. I'm just saying what some people have done, what's possible. So a 22-year-old 21st century member, what he did is he decided he wanted to invest in the stock market and he wanted to rent out shares, as an example. Quite a few years ago, so he borrowed $40,000 and in a personal loan. He had a job, so he was able to get that, and he invested that into the stock market. Now, some people say, isn't that risky, borrowing to invest? The answer is, jot this down, risky compared to what? There's a risk to everything we do in life. So it's not whether something's risky, it's okay. If he does it, there's a risk. If he doesn't do it, there's a risk as well. What do most 22-year-olds borrow $40,000 for? A car. Now, the risk of a car is 5 years later, has it doubled in value? It's a loss-making investment. If he invests in quality shares that he educates himself on in a stock that he's happy to own, is there a risk he can still lose money? Yes or no? It's still a risk. Could he insure his shares? He can minimize his downside. But if he's also learning how to rent out those shares, can he generate cash flow? And is there potential for him to profit? And is it potential for him to have money working for him? Absolutely. So he's got to weigh those two up. If he's got a good psychology, he's educated himself, he can now take advantage of strategies the average person can't because they simply don't know about it or they don't have the psychology to do it. He also, what he did was then get a margin loan. Because one thing you can do through stockbrokers or via the banks is get a margin loan. Not as popular as it used to be. In that case, he was able to then have $80,000 of borrowed money at work in the stock market. Okay? So he's borrowed to buy an asset. Okay? And that's what he's able to do, is able to generate as much as $4,000 per month in cash flow, okay, from renting shares. So as an example, that's a way without, no, I'm saying do this. I'm not telling you to do this, okay? Even though I'm licensed to give general advice, I'm an educator. My goal is very clear, to educate you what I've done and what other people have done, what is possible. Ultimately, to live above the line, who's responsible for your decisions? You are, okay? So I don't want to hear in 3 years' time, I bought a stock and it's Jamie McIntyre's fault I lost money on it. Will I ever tell you what stock to buy? No. Never. Okay? So you can't blame me if you lose money. Guess what you're going to do? At times you will what? Lose money. So will you spit the dummy?
2 minutes.
2 minutes you can spit the dummy for. Okay, that's good. And then you'll build a bridge and get over it. Okay? If you can't take a few punches, like saying, I'm going to be a world champion boxer, but I don't want to get hit. There's a contradiction there, isn't there? Okay? You want to be a successful investor, but you don't want to lose money. No, get used to it. But you're going to lose small amounts of money if you're smart about that and have the chance to win big amounts of money. Okay? Where most people can't handle that, so they miss out on winning the game of life. So What's the next one? Number 6 is the most common way most of you would do it is equity. Have some equity in your house that you would pull out. So let's say you have a house, then you might have, let's say it's a $500,000 house, and you owe the bank, say, $200,000. You can borrow generally up to 80% and get a line of credit on your house. 80% of $500,000 is how much? $400,000. So they can increase the loan, say an example, from $200,000 up to $400,000 on your house. That means there is how much can you draw out of that house. There's spare $200K here in equity that you can draw out and do whatever you want with it. Does it make sense? You can buy a car, go on a holiday. Now, obviously, we don't recommend that. If you're going to do that, you'd pull it out to do what with it? Invest. Probably deposit on a property maybe, or you might do some share renting if that's what you wanted to do, or type of investment that you're comfortable with. And you mightn't use the whole 200. You always keep a buffer, and you just start small and use a small amount of it. Now, some people say, but Jamie, isn't that risky? I've worked really hard to pay off my mortgage or get most of it paid off. I don't want to take the risk of doing that. That's up to you to decide. But once again, risky compared to what? And if you do it, there's a risk. If you don't do it, there's also a risk. So make sure you weigh up both risks. That's intelligent. Because let's say, wind back the clock 10 years ago. And if person A, let's say they worked at the same job, they had to live next door to each other, had the same valued house. Let's say they had a house worth $500,000, okay? Let's say $600,000, okay? And, well, let's go back 10 years ago, say it was $300,000. And they lived next to each other. One person was conservative, and they worked in the same job and said, you know what, I'm not taking the risk, I'm not going to borrow against my house, okay? It's too scary. The other person goes, I'm going to. And they took some money out of here, out of the house, and they bought over a couple of years period, they bought a couple of houses worth $300,000 each. Make sense? Now, they're doing the same job, same income, they live next door to each other. 10 years later, what's happened to the person that's done this? Let's say these houses are now worth $600,000 each. Has this person had to work any harder than his friend, his next door neighbor? Same job. Hasn't actually worked any harder. But he's now made, what, $600,000, probably got more because he's paid down the debt on some of this as well. That's if he stopped at 2. His neighbour now is still buying lotto tickets. His neighbour's going to have to win lotto to catch up to him. Does it make sense? I mean, ridiculously simple. By getting himself to take action, get educated, get some finance, get out there 10 years ago, and that would create momentum. He then could probably have learned some other things, say renting shares, as an example, or building a secondary income. And those little bits over time start to make a very big difference to one's retirement because they got themselves to act. That's what it's all about, okay? Now, people go, well, that's all right. Let me ask this question. Who here wished they'd bought more property 10, 15 years ago? Of course, everyone. Now, that's called hindsight. To become wealthy, you have to have what? You have to be able to get yourself to act in the moment. Even right now, you go, well, what's going to happen in the future of the property market? No one knows. It's uncertain. But people that can act, and then you wind the clock forward 10 years, what you have working for you in the property market, why you always generally get at least some slow to moderate growth, is a thing called, jot this down, inflation. What people don't understand is inflation as an investor is a good thing. Inflation is the enemy, not of us so much. The people that don't like inflation and are always talking about it. Who is always worried about the inflation figures? Tell me. The Reserve Bank. Is it true? Not pensioners. It's the Reserve Bank. All they're worried to keep inflation between 2 and 3%. Why? Because they represent the banks. Banks hate inflation. Inflation is the enemy of the banks, not so much our enemy. What do I mean by that, Jamie? Well, if you'd borrowed $1 million 10 years ago, interest only, and you still owed that $1 million today, the $1 million today is not worth as much as it was 10 years ago, is it? Inflation has effectively shrunk the money you owe. Does it make sense? That's a bank's problem, not our problem. It actually works in our favor. If you understand that property inflation is leveraged. Leveraged inflation, jot that down. That's a new word for everyone. Leveraged inflation. Because as a property investor, that's what you're doing. You're getting leverage over inflation, and that'll make you wealthy. Some of you are going, I'm not getting what you're saying. I'll explain it to you. No one's ever heard that before. It's probably the first terminology that's ever been used. Okay? Can we put a quote that I invented that one? Okay, so what I mean by this is, let's say you put a 10% deposit down on a property. You borrowed 90%. Make sense? And inflation ran at 3%. You have leverage on inflation because you're times 10, basically. 10% deposit, you've got times 10 that of the portfolio. Okay, a $100,000 house, okay? You only put 10K in. You leverage the rest. So inflation is times 10. It might be at 3%, but the times 10 is getting you the growth on your money. Does it make sense? So let's say the property market only rose 6% per year. 3% of that might be inflation. But times 6%, times 10, you haven't made 6% on your money, you made 60% on your money. Okay? If I'm confusing some people, let me make it simpler. Who's with me? Yep. So you're just getting inflation. So when people say, financial planners say, don't touch the property market, put in managed funds, stock market average is 13%, real estate only averages 6% growth or 7% growth, they're not counting apples with apples. Because generally in the managed fund, you're using cash. You're not generally leveraged, okay, even though they do that at times now. In property market, it's normal to be leveraged 90% on a house, okay? So if you put a 10% deposit in of 10K on a property, that's a 100K property. If that property rises 6%, that means that the property is now worth 106K, right? In a year's time, so. It's risen 6K. 6K on your outlay was how much? 10. You outlaid 10, but you're now worth 6K more. 6,000 on a 10K outlay is what percentage? 60%. Does that make sense? So it's leveraged inflation. Leveraged inflation, effectively what you're doing. Inflation's helping you become richer. Now, admittedly, a portfolio in the future, you'll need more money because inflation is actually eroding the value of the money. But the value at 3%, it's eroding. In this case, you've got 60% gain. Or even just based on the inflation, you've got 10 times that. So you might got a benefit of a 30% gain on inflation as a benefit, but you've only lost 3% because it's worth 3% less. Make sense? The point is you have leverage. That's one of the reasons why property will generally continue to rise over the long term, purely just from inflation driving it. Also, because you know what your income in 10, 15 years, will people be able to afford a lot more expensive home, yes or no? They'll be able to afford that because incomes have risen. They'll be able to afford that. So that's why you'll be surprised when you think property prices can't continue to rise. In 1980s, they said Sydney property prices are too expensive. And this is where the other flaw comes from the argument. Professor Stephen Keen will argue, they say, well, Australian property prices are expensive. That's why they're going to crash. True, they're expensive. But they've been expensive for a long time, correct? Sydney was expensive in the 80s, didn't crash. Yeah, but Australian property prices are overvalued. That's why they're going to crash. True, they are overvalued. Some of them are above their intrinsic value because the rental yields are so low. But doesn't necessarily mean it's going to crash. Okay? So, quickly, let's go through this. Number 7. Jamie, what if I don't have any equity in my house? That's what your parents are for. Okay? See if you can borrow some money from your parents if you be good to them. Pay them more visits. If your parents don't have any equity, go to the next generation. Number 8 is superannuation. So here's what is exciting, is that, thank God, I mean, I don't agree with Paul Keating on many things, but one thing he did do, which was good for the country, is he introduced superannuation. The other thing I agree with him, as he said recently, is that most Australians have their superannuation too heavily weighted towards shares through equities. And I agree totally with that. It's too much weight in there. The financial planning industry loves superannuation because they can charge you all these fees for all your money for doing diddly squat. I would say, jot this down, rebalance your superannuation money more towards property than the stock market. The stock market will be up and down like this. If you want to retire on that, you'll be like nervous, you'll lose your hair sooner. That's why a lot of baby boomers are scared. The credit crisis in 2008 made a lot of baby boomers panic. Yeah. So you can take, through self-managed super. So Warren last night would have spoke about that. If you missed last night's session, you can still see him here. He'll be doing consultations this weekend if you need to see the accountants. So most of our members would at some point set up a self-managed super fund, which means instead of someone else managing your money, you can dictate where that money is invested, and then weight some of it towards real estate. So it's not just all in managed funds in the stock market, because that's buy, hold, and pray, and hopefully they're still there when you come to retirement. You want some real estate where it's a little bit more certain. Make sense? So what's exciting about super is that, let's say you come to a financial education seminar like this and you want to invest, but you don't have any money. But you know, the average Australian has at least $25,000, $30,000 in super. Is that true? You know, if you're really young, you mightn't even have that, okay? But the average super account is something like, $500,000. That's because there's some super accounts in Australia that have $100 million in them, okay? So the medium average doesn't really count. It's distorted. But most people that have at least $25,000, $30,000, $35,000, $40,000 in super, or soon would have that, okay? So what it means is that with your super account, many of these investment strategies you can use. So you're sitting there going, I really like this, but I just can't figure where I'm going to get some money from to start doing this stuff. Superannuation. Many of you have it, and you can actively invest that in many of the strategies you may want to do. Is that good news? How do you set one up? Speak to the accountants. It's not very difficult. It's one of the fastest growing industries in Australia right now, self-managed super accounts. Everyone, or not everyone, a lot of people are getting them opened up. Now, ASIC and those government departments say, well, you need $200,000 in your self-managed, in your super account before it's worthwhile doing a self-managed account. They are overly conservative. How much you need in your account to make it worthwhile to set up a self-managed super fund account is not determined on how much capital you need. They're basing it on miserable returns. If you only get 5% return on your money, then you need, say, $200,000 to make it worthwhile. But what if you could get 20% return on your money? That would make sense. You need 4 times as less. $50,000 would make it worthwhile. In some cases, $20,000, $30,000 for some people, subject to the return. So the return dictates how much money you need in super to be worthwhile the cost of setting up a self-managed account, because there is cost to it. You've got to do the auditing, and every year your accountant's got to do that. They'll charge you a fee for that. This makes sense? Quickly, I want you to identify which of these 8 areas you're currently using to raise money for investing, and which are the areas you could start using, and share it with your buddy. Go for it quickly. So at least 5 best things you've learned and 5 action steps, and share with your buddy. Is this making sense so far? So we looked at how we can come up with some money to get started. Let's go into the share strategies now. Look at Warren Buffett methodology of selecting stock. Let's look at 6 share strategies. Let's rent some shares. Then I have a special guest speaker for you who just happens to be in the Gold Coast this weekend, works out well, is a 21st Century member. Some of you may have heard about this gentleman. At 78 years of age, he did a particular strategy, started making $40,000, $50,000 a month with one of the strategies you're about to learn. So we're going to do a quick interview with him to share his story and some insights if that's of interest to you. And then we have a speaker that will speak for half an hour and recover some of the share renting concept before we go for a dinner break. Then after dinner, I'll come back on briefly and talk to you a little bit about the land banking concept and how I use that and how that's worked well for me and how you can possibly replicate that strategy. Not easy to do, but they'll talk to you about how that is possible for some people to take advantage of that. And then you have one final speaker tonight after that. Okay? So you're halfway through the day. How are you feeling? And we just turn the aircon back on so you'll cool down. Some of you are too cold. You like it warm, huh? I guess that's why you moved to Queensland. Is this making sense? Okay, let's look at the stock market. Now, any of this is on the Homestudy. Many of you, this program, I'll just quickly go through a disclaimer. Disclaimer just basically tells you that I'm licensed to give general advice. I don't give specific advice anyhow. I'm not going to sit down one-on-one with you and look at your financial plan. I don't do that. I'm not available for that. And I'm also an educator. As opposed to, even though I'm licensed, my goal is not to give you advice, as I said. Okay, let's look at the stock market, shall we? We're going to go through some examples of what we can do here. Jot this down. Let's say this is a chart of a share, and the share price has been up and down, up and down, up and down, which is currently what's happening to a lot of stocks. And let's say this share is called XYZ. Don't ring up next week and go, Jamie McIntyre's full of it, XYZ, it doesn't exist. Seriously, this has happened before. People are like, some people, I don't know. XYZ, just so we're really clear, here's an example. The stock doesn't exist, okay? And let's say it's been up to $19, okay? So, there's two forms of analysis in the stock market. One is fundamental analysis. The other is what? Technical analysis. Warren Buffett is a technical or fundamental? Fundamental. So fundamental is looking at, in the stock market, intrinsic value, profit and loss of a company, looking at the profit and loss of the company, the sales of a company to see what that will do to the future share price. If it makes more profit, you expect it to continue to rise in value long term. Technical analysis is more technical, but it's used more for the shorter term trading. It's following the charts and patterns in a stock to identify short term trading trends generally, okay? Where fundamental's better for longer term trading. If you can only do one, what should you do? Technical or fundamental? Fundamental. You must understand fundamental investing. If you understand that, you can make money. If you only understand technical and don't really understand fundamental, then I think you put yourself at risk, okay? People like to overcomplicate things, especially technical type people. So they go, I need all this complex logarithms and stuff, but like, it makes sense, okay? People that make most of the money, the ones that are really smart, fundamental investors, common sense, keep it really simple. When I go through Warren Buffett's strategy, it's incredibly simple, almost too simplistic. Goes, is that all there is to it? No, it has to be more difficult. I need to buy an expensive piece of software and check out the logarithms and really see where that's going to work for me, okay? You don't need that. So, what we're looking at here, one, we've got to know when to buy a share. So if you've never bought a stock before, okay, know when to buy. We've got to figure out when are we going to buy a share, what sort of share would we buy. Most people will just take a hot tip, listen to a taxi driver, etc. We don't want to be guessing. What we're going to do is, let's model Warren Buffett, okay? Warren Buffett has some core principles of what he buys in stocks. He's obviously a very successful investor, renowned as the greatest investor of the current century. We've tried on numerous occasions to get Warren to come to Australia and speak. He's a very difficult man. He doesn't speak. Very rarely will he do that. So it's not likely. So we're trying to at least maybe at a future financial education summit, at least having via video, that might be more possible. But he's in a lot of demand, and he just doesn't really speak that much other than outside his shareholders' conferences, which you can go to if you're a shareholder. It'll cost you about $83,000 for a single share in his company. But if you're a shareholder, even then that doesn't guarantee you access to the shareholders' convention because there's too many of them. They can't fit them in the auditoriums. So Warren Buffett says this. Here's 3 key rules that he has for investing. If it works for Warren, can it work for you? Yes or no? Yes. Doesn't mean you'll become a billionaire. Yes or no? Yes. Possibly, but not necessarily. But if you could become 1% as successful as Warren Buffett, would that be worth your time and effort in learning? Yes or no?
Yes.
Absolutely. So his number one rule, Warren Buffett will only ever buy a company or stock that is profitable. Hallelujah. How complex is that? But how important is it? He won't buy into companies that aren't profitable. Therefore, Warren Buffett, they tried to discredit during the dot-com days over a decade ago, saying he's lost his marbles, he's old school, he doesn't get the new technology, he's not investing in dot-coms, he's lost it. Or had he? His rules were they must be profitable. 99% of dot-com companies were not profitable. They barely made a sale. So he breaks my rules. He's not going to go into it. Most people are just buying a stock at 10 cents, hoping it goes to $1. Didn't care whether it's going to be profitable. They're hoping just to pass the shares over to someone else. Okay? Musical chairs, whoever's left holding them loses. Okay, that's basically what people are playing. Okay, so number one rule is it must be a profitable company. As an investor, here's the way you treat it. Okay? Treat investing in the stock market as if you're buying a business. If you're going to buy a news agency here in the Gold Coast, would you want to know it's profitable? And you want to be able to know the books are reasonably accurate? You certainly want to know that. Okay, so it's just common sense, isn't it? Number two, he only ever buys a company, jot this down, he only ever buys a company that he knows and understands how it makes its money. That he knows and understands how it makes its money. For instance, when we're going to look at companies, we want to know how they make the money. For instance, would have Warren Buffett invested in Enron shares? No, because one, you couldn't even tell if it was profitable, even though they were telling you. You wouldn't trust the books. And two, did anyone know how Enron was making money? No, no one knew. It was so complex that they were able to fool the market long enough and show all these profits, but whether they were making profits or not in this energy trading and whatever was dubious, because what they were counting profits, were they really profits? You didn't know what was going to happen for 5, 10, 20 years with energy prices, etc. So were they really making a profit was very suspect. So he wouldn't touch it, because if you can't understand how a company makes its money, how can you understand whether it's likely to make more in the future or not? Amex. Warren Buffett owns Amex. Not owns it, owns shareholding in it. Do you understand how Amex makes its money? They charge merchants, business owners, generally 3.75%. So if you pay for something on your Amex card, that's why a lot of places don't take Amex, you notice. Because credit cards will charge 1%, 2%. Amex will charge. But Amex has got a great business. Just charging. They get a slice of all this consumer spending and business spending. Coca-Cola. Warren Buffett is a big investor in Coca-Cola many years ago. Do you understand how Coca-Cola makes its money? Pretty much, it produces a drink, costs maybe 10 cents, it sells it for $3. And he predicted years ago, it would continue to grow because third world countries, it was expanding all these markets. So he bought Coca-Cola shares, and he was right. It's continued to grow as it spread around the world. Okay? Do you understand how Apple makes its money? Okay, so often what you want to look for if you just want to buy and hold a stock is a stock that you're a consumer of. Who thought years ago, wow, Apple would be a good company to own shares in? Has anyone ever thought that even today? Because you go, wow, if you find a business where people are queuing up outside the store, you should go, I wonder if they're listed on the stock market. Maybe I should buy a stock in them. Does that make sense? And Apple has continued to rise. There is a classic. Do you have to be a stock market guru to figure out that Apple shares were not a bad deal? Are they profitable? Yes or no? Yes. The first or second, varies by the day, most profitable company on the planet. Okay? Apple has more cash reserves than the Federal Reserve Bank. Which actually doesn't have to be that much, but seriously, it has more cash reserves. Okay, Apple doesn't even need to be listed. I mean, it doesn't even need to sell its shares. It has so much cash, it can just buy companies with cash. Okay, unused cash. It's so rich, and you know how it makes its money. People love their products, so therefore you go, as an investor, is it likely that Apple will continue to grow? You'd probably say yes. Now, if you also knew something about Apple, Apple lock in their distributors or their selling agents into 5 or 10-year contracts. They know exactly what their sales are already for next year and year after. Like, say, Sprint Telecom. Sprint just took on Apple because the other two, AT&T or whatever the other one is in the US, were the only ones who were able to sell, like a Telstra, sell Apple products. And the other one, Sprint, wasn't allowed. So Sprint wanted to be able to sell iPhones, otherwise they're going to know who's going to sign up to the network. So they had to pay and lock in a 5-year agreement to buy something like 20 million iPhones over 5 years. Minimum agreement. If you want to be able to sell our products, that's what you have to buy. So Apple already knows for the next 5 years, just one reseller, how much sales they make. It's locked in. So if you also knew that information, you could then know, well, we know their sales are likely to continue to rise. Now, some people, the uncertainty in Apple, though, would have come from the death of Steve Jobs. Is that true? To go, what's going to happen? He's such an important part of Apple. But short term, you could probably go, well, Apple's so strong and growing, that impact might take 5 or 10 years before they could potentially lose direction and focus like they did when they sacked Steve Jobs back in the 90s and they brought him back in to save the company. Okay? So there's some things to know. I'm not saying go out and buy Apple shares, but I'm saying as an investor, is it quite simple and you keep it really simple? Is it making money? Do you know how it makes its money? The third thing, though, which is critical, this is critical. The third thing is he'll only buy a company that he believes is undervalued. Make sense? Important criteria is you go, Apple makes money. Yes, tick the box. 2, do I know how it makes its money? Absolutely. It sells something to everyone on the planet pretty much. 3, important question. Is it undervalued? That now is more of not a black or white answer. That's more of a judgment call. And this is where you're going to have to develop your judgment. This is going to become not a right or wrong answer. This is going to become an individual answer of what you judge it to be. But that's an important criteria. You see, it narrows it right down. Is it undervalued? Why would Warren Buffett want to only buy undervalued stocks? Because he wants to outperform the market and do really well as he has in the past. So he doesn't want to just make a little bit of money. He wants the opportunity to make a lot of money. So a company like Apple, for instance, would be, well, I'm going to invest in it until it comes to, is it undervalued or overvalued? Then you have to go, I'd have to do some more research. Okay? Now, obviously on Monday when I go through the BNS strategy and a few other things, I'll talk about some other things about the stock market, how you can help answer that question without getting too technical for you, but that'll give you some more insight on that. Okay? But even you could just make a judgment call. Let me ask you this question, knowing what you know now about Apple. Who thinks Apple is overvalued? Few people. Who thinks it's probably pretty much on the market where it's valued currently? And who thinks it's undervalued? And who has no idea? Okay? So as an example, so you've got a consensus of different opinions there. Most people think it's probably priced at the right price at the moment. I haven't been following Apple shares enough to know, but maybe if the market's pulled it down a little bit because the sentiment of the market is down. See, what's great, here's what's great. When people get scared, let's say the uncertainty, okay? Because remember, people's strongest human need is certainty, right? So all this global uncertainty freaks people out and they pull their money out of the market. So when there's uncertainty in the market, does that decrease the chances of finding companies undervalued or increase them? Increases, because the market sentiment drags the whole market down. So even good companies like Apple, their profits are rising rapidly. The price should be going up. Sometimes they can be dragged down, which means they're dragged down below what they're really worth. So in a downward market is actually the easiest time to buy companies below what their intrinsic value is or below what they're really worth. Make sense? So that's when you should be excited. Chinese proverb, crisis equals opportunity. And that's why Warren Buffett is, remember, a contrarian investor. He will go in and remember 2007, 2008 banking crisis in the US, what was he doing? Buying into Goldman Sachs, etc. And he was smart. He wouldn't just buy chunks and then go, here's what I want to do. I will give you this money on a warrant, and on a contract basically. I want minimum percentage return guaranteed. And then I want the option to convert what I've given you, loaned you, into stocks at this low price. So he wins both ways. He gets a guaranteed high percentage return with the option of converting to purchasing the stock. Smart. And that's what he did in Goldman Sachs. He made a lot of money out of that, when no one else would touch banks. Now, you're saying Warren Buffett, I guess you could come in and help out a lot of banks, and he's so big you can actually distort markets. So is it starting to make sense? So in a downward market, you should get excited. What we're seeing now, is this sort of in the whole market overall, what we call, this is called channeling sideways, we talked about before. So you're going to see more undervalued stocks. In a boom market, that's when it gets harder to find undervalued stocks. That's when it gets riskier, but that's when everyone feels more comfortable buying, because everyone else, the taxi drivers are buying, your neighbors are buying stocks. Everyone's going, okay, what should I do? Buy some stocks. Everyone else is, okay, I'll do it. Because what people do is they rely on external validation. If everyone else is doing it, they will do it. It's much harder to have the guts when no one else is doing it, go, you know what, I'm going to do it. I don't need external validation. I'm going to make up my own mind, and I'm going to be responsible and accept I could lose some money and go against the trend. That's why most people aren't wealthy, because they rely on external validation. Repeat after me. Something to think about. That's why my millionaire mentor said, Jamie, what other people think of you is none of your what? Business. Stop worrying about what other people think, because most people don't. Most people are busy with their own lives, so don't worry too much about what they think about you, okay? Get on with your own life. Don't rely on external validation. If everyone agrees with something, generally it's not a good idea, okay? So, is this making sense? Now, it's incredibly simplistic, but how important is how many people, probably even in this room, have lost money because they've neglected those 3 rules in the stock market? Who's neglected? Didn't even know it was making money, okay? Didn't even know how it made its money, and had no idea whether it was undervalued, overvalued, just like, I just want to make some money, I'm just going to do this quickly. So as I go through these strategies, if you forget these rules, don't blame me, okay? Because these rules are critical. If you stick to fundamentals, you'll make the strategies a lot safer. If you get lazy or greedy and forget those lessons and just move on, I can just make some money short term. I'm not worried what the stock price will do. I'm not worried whether long term it's a good stock to hold. I just want to make some short-term rental income or short-term premiums from selling insurance, and then you'll wreck the recipe. Number 2, jot this down, is channeling. All you have to do is just channeling, and you can make a lot of money. But I teach you this because when you're renting shares or selling insurance, you need to understand channeling. Channeling is this. It can channel upwards, it can channel sideways, it can channel downwards. It's a stock going up and down in a channel. And in the market right now, this is what I predict will start happening. So this is not a bad time to be channeling, because you'll see the market will rise and realize there's not going to be a recovery for a long time. It'll drop back down, disappointed. Market will rise quickly, back down. And this is what you've seen is happening, and will continue to happen. Europe, it's going, the banks are about to collapse, it's all over, and they come up with a Band-Aid solution to push it back a little bit and save it, Greece for another few months or Spain for another few months. And people are like, phew, that was getting close. And then more bad news will come out, another country's about to go under, and the market will panic, and then they'll extend a loan and push it back. So all these things is what's going on, this uncertainty, which is good. See, here's what a typical person will do. They'll do no research on the company, and they'll just buy it when everyone else is, and they would have bought this company at $19. They come back 12 months later, okay, the company is still at $19. They go, this is a waste of time, this stock. It's gone nowhere. Where if you had been following the stock and you were about channeling, you probably would have bought it at the bottom of the cycle, okay, because you saw it did that before, went up, come back down. It's amazing when you study history, it gives you a lot more insight into the future. And you go, okay, I'm going to buy it here, but last time we got up to here, it come back down, so I'm going to sell. I'm not going to be greedy and hope it goes to $21. I'm just going to sell. And if it comes back down here, I'm going to buy it, and I'm going to sell, I'm going to buy, I'm going to sell. In that example, instead of making, let's say you made 20% here, you've made 20% 3 times in the year. So let's say you've made 60% on your money. The other average person who hasn't done their homework has made 0% other than dividends and said this stock is useless. You have actually made money on the stock. Does it make sense? Now, I know I'm simplifying the concept, but is there stocks that will channel 3, 4, 5 times in a year? Yes or no? Yes. Is there stocks that will do that in a month? Yes. Now, to do it in a month, you have to be using technical analysis, much harder to predict. Over the course of a longer period of time following fundamentals, it becomes much easier to predict. Making sense? I'm not saying easy, easier. Now, if you're new to the market, you have less knowledge, so you are competing against people that have more knowledge. But the only way to get that knowledge is get in the stock market. When you're following a few shares, you'll naturally start to notice. You'll read the papers. I read the Fin Review a lot. The Australian, you should be reading these papers because they'll talk about particular stocks, okay? And you'll start to get familiar with profit reporting, what's happening in the company, and you'll get innate knowledge about a company, which will give you an advantage over people that don't, okay? Number 3 is leverage. So what you can do in the stock market is you can leverage. Justin will come and speak to you on Monday, Justin Beedham, if you want to look at a particular strategy where you can leverage up money in the stock market. Okay, a little bit like what Storm was doing, but add inbuilt protection. These strategies generally in a rising market can work quite well. In the last few years haven't been overly exciting because the market's been all over the place. But it's a way, now it's one way to get leverage. Other way is through the stockbrokers. You can speak to them and they can organise a margin loan. So in other words, if you had, $40,000 like that example before to invest, then you could borrow, say, another $40,000. You could borrow more, but let's say $40,000 through what's called a margin loan. It's a loan for borrowing for stocks. Number 4 is insure your shares. We'll look at that in a moment. So most Australians out there, if you said to them, do you know that you can put insurance on your shares in case the market crashes? They go, I didn't know that. Just like you insure your house or your car, you don't do it through an insurance company. It's done through the broker. The word insurance is a terminology I created. It's not the technical word for it. We'll cover that, the technical word, what it is, in a moment as we go through the strategy. All you need to know, though, the concept, you understand insurance? You pretty much got it. Now, we insure for 2 reasons, because not only can protect you, but insurance is what I call make money on the way down. So I call it the way down strategy because I want to use really technical, complex words. It makes me sound more sophisticated. So a way down strategy is insurance, but you're actually using it to profit when the market comes down. If you knew you could profit from a market crash, then you start to become less attached to the market rising. Remember, emotional intelligence is letting go of things you don't control and focusing on the things you do control. As an investor, it's super critical. You shouldn't be going, buy this stock, I hope it goes up. You're praying to God the stock goes up. What if someone else on the other side of the world is praying to God the stock goes down? What's God going to do about it? It is not God's job to have you rich in the stock market. He's a little bit busy, or she, okay? The point is, you've got God-given talents, the ability to think and co-create and make decisions and free will. That's enough. Don't expect any more. So you shouldn't be praying the stock price goes up or down. You should be going, if I buy this share, I accept it can go up, down, or sideways. I already accept that because I'm living above the line, which means I'm accountable and responsible. I'm not going to blame or make excuses. True? Therefore, if it goes up, I'm going to do this. If it stays sideways, I'm going to do this. If it goes down, I'm going to do this. You already preempt and have your strategy in place because you don't control the market. And if you ever do, you'll go straight to jail. You don't need to control the market to make money. You just need to go, if this happens, I do this, I respond. If that happens, I respond. And have the toolkit and resources and knowledge to know, shit, if that happens, oh, you can do this. If that happens, I can do this. And then don't be greedy, because fear and greed is what drives the market. Fear will cause the stock market to crash faster than it will rise. So notice that? When the stock market comes down, it comes down in a hurry. To rise, it takes longer. Greed will drive it up. So human emotion is exaggerating the stock market, because really it should be more even, because companies' profits aren't generally going up and down like this. They're more even generally. The stock market should be more even. But it's not, because it's based on human emotions of fear and greed. We're the most successful investors. Are they really greedy, yes or no? Is Warren Buffett freaking out? Does he ever look any different, any expression on his face other than cool, calm, the wise granddad? Doesn't seem to be pressured. Even through the credit crisis, did he see sweat pouring down his face? You know, he has billions of dollars in the market. You'd probably be freaking out. He's staying calm and cool, not attached to the outcome. He's not losing sleep over it. If it does this, I'll do that. If it does this, I'll do that. Oh, there's an opportunity. Do my homework. Yep, I'm willing to take a bet. I could be wrong. He loses money at times, but I'm stacking the odds in my favor. That's what you want to become. Make sense? Number 6 is making money on the way up. So you can actually make money on the way up without owning the stock by using options, and we'll give an example of that in a moment. It's called the way up strategy. You can make money through the stock price rising without actually owning the stock. The question you'll have, who's going to rent our shares, or people that want to make money on the way up without owning the shares. Number 7 is renting shares. That's what we're going to look at. That's a strategy you can do. And number 8 is selling insurance. That's another strategy we're going to look at. That's what John Thompson has made a lot of money from, and others. We'll look at that as well. Make sense? So there's more strategies than that, but that's enough to get started. I'll teach you a few of these because you can use these in tandem. Now, you can go and learn renting shares from numerous places, but there's a certain recipe of the way that we do it that maximizes the upside and minimizes the downside. If you change the recipe, you're not going to get as great a return. So it's a little distinctions that can make a big difference. Let's move on very quickly. What we're going to look at here is renting some shares. So what we're going to look at the moment is the newspaper when we go through this. Let's say this is you. You can put your name here. This is you on the side that's going to rent them. And over here is, let's say Simon is an example of someone, my brother-in-law, that trades the option market. He's someone that will pay money to rent people's shares effectively. You don't have to find Simon's phone number to see if he'll rent your shares. The stockbrokers, Andrew, who'll speak to you shortly, through the brokers, there's a market there, it's already there, okay? So let's say you're going to rent shares out on XYZ. You've done the Warren Buffett strategy. You've bought XYZ at $16. You feel it's undervalued at that price. You know how it makes its money. And it's profitable. So let's say you look in the newspaper, like we're going to show you how to do it in a moment, and let's say the share price, you're going to look in the paper and it's going to have all these different prices. You can rent it at $16.50, $16, $17, $18, etc. Different prices. So let's say we're in the month of December. It's not a very good month for renting shares out right now because why? It's a short month coming up to Christmas. January's not a good month either, okay? So you can practice for a few months if you want before you get into it or start because it's a short trading month. Everyone's on holidays, okay? But let's say you were going to do it for December. Then you'd be able to look up, which we'll look in the paper in a moment, and you'll see that there'll be different prices available. Say at $17, you might see that there's 44 cents available in rent per share that you rent out at $17, okay? And then it might be at $16.50, it might be 88 cents, okay? At $18, you know, do different prices. So let's just stick to this price here. Let's say we pick whatever price you wish to rent it out at, it's 44 cents. Now, generally when you're doing this, the rule is you'll rent out your shares above the price you bought them at or below. Some of you don't know because you're just learning this now. The answer is above. Why? Well, let's cover what can happen. If you get 44 cents a share, you would then ring your stockbroker and go, okay, yep, I'll take that money. The market sets that money. And let's say you have 1,000 shares. How much is 1,000 times 44 cents? $440. If you had 10,000 shares, how much is it? $4,400. That would be a monthly income for that month that comes in. You made that phone call, a couple of days, it's in your stockbroking account. It's your money to keep. It's effectively like renting it out for the month. But two, what's the second thing that happened? Well, there is a clause in this rental contract, okay? And that clause is if the stock market, the stock rises in value before the end of December, and let's say the $16 stock you bought, it's risen and it goes above the price you rented at. Let's say you rented at $17, if it goes above that price, then your shares can be exercised, okay? People go, don't do that strategy, your shares can be exercised, and people freak out. It's like, my God, what's going to happen? The stockbroker's going to take them for a jog around the block? Not likely. It simply means they are what? Sold. No big deal. Yes, they can be sold. You already knew that. That's why you made sure you rented them out at the price above what you paid for them. $17. If they were sold, do you still get to keep your rent? You still do. Plus, wait, there's more. You also get, you bought them at 16, sold them at 17, you make what, $1? That's $1 you make in there per share. 1,000 shares would be $1,000 extra. 10,000 shares would be $10,000 extra. But Jamie, won't I have to pay brokerage? Yes. Who's happy to pay brokerage if you make extra money? Yeah, of course you'll pay brokerage. How much depends online broking or full service broking. In the beginning, it doesn't hurt to do a bit of full service broking till you get your head around it and then move to online broking once you're comfortable with it. So, does that make sense? Well, okay, smarty pants, what happens if the stock price goes down? Well, no, that would never happen, would it? That can happen, you already know that. So, once again, $16 if the stock price drops down. Let's say it drops to $15.50 at the end of December. You still keep your rent true, so you got your 44 cents. It's dropped 50 cents on paper. Take the 50 cents on paper loss off. How much have you lost? 50 cents on paper or how much? Only 6 cents. Is that a good thing, yes or no? Well, it's actually better than if you didn't rent the shares. So here's what you've got to understand with this strategy, is this. Remember yesterday I said I'd show you an example of how you can increase your returns on an investment by lowering the risk, because most people say to make higher return you have to have higher risk, and I said, well, that's not necessarily true. This is a strategy, a unique strategy, where you're actually increasing the return on your stocks by getting a rental premium by lowering the risk of owning the stock. In other words, in this case, if you didn't rent out the share, you would have lost 50 cents on paper, no big deal, share prices go up and down. Because you rented it out, you got 44 cents, which offset most of the paper loss. It makes sense, you're actually better off by generating that rental income because you got that extra income. So you actually increased your return by minimizing your risk. Is that pretty unique? So quickly turn the person next to you, teach them how to do that, and then we're going to go through the newspaper and do some trading. So at least 5 best things you've learned and 5 action steps, and share with your buddy. Nope. Let's move on. Okay, we'll start down the front here very quickly.
The Australian market, I know there's always 1,000 shares for a parcel for options.
Yep.
So it's gone down to 100 shares now.
Yep.
So has that increased the liquidity and made it better for trading in the Australian market?
I don't know whether it would increase liquidity so much because it may to some degree. The US, what the difference is in the US, one contract was always 100 shares. In Australia, up until recently, if you watch my DVDs even, it says, you have to have 1,000 shares, which is one contract in Australia. That's the way it's always been. Recently, that changed where you can do it on less. You ask Baxter that question, he would have more of an answer, whether he thinks it's increased liquidity. He'll be on shortly, and he'll go over this concept. He's a stockbroker and also an investor. So if you want to ask him that question, or he'll be around. Yep. It hasn't made any noticeable difference to my knowledge. Any other questions? Okay, a lot of these questions will be covered as we go through the next stage. Do you have a newspaper in front of you? So if you're going to do this in the Australian market, you could look up the newspaper. You could also look up the ASX website. All the option premiums are there. So let me go through some wording for you. On this is out of the Australian Financial Review, and this is dated Friday, 18th of November, so it's a couple of weeks ago. It says on page 34, up the top, it says call options. See that? Circle call options. What that means is share renting, basically. So the word renting shares, etc., is basically slang. It's not the physical, it's not the technical wording. It's a wording I just created because when I was trying to educate people starting 12 years ago, I wanted people to be able to rapidly learn. If you go to typical boring financial seminars just talking about some of these concepts, you just won't, most people just won't get it. It's like too hard, too boring. It just, you've got to understand it. So what I needed was a word that you'd understand. The way we learn, if you understand human psychology, the way we learn is we know something that we know, and to learn something, we attach the unknown to something that we know. I.e., tutonga, tutonga. Tutonga, tutonga. Is that right? Buffalo, buffalo, tutonga, tutonga. Who's watched that movie? Kevin Costner. Dancing with Wolves. No wonder some of you are looking at me weird. He was trying to communicate with the Indians. We link learning through something we don't know with something we know. So he's trying to get into, what is a buffalo? Okay, they understand, buffalo, buffalo. Okay, we know a buffalo. So we link that to something we know. Renting. You know how to rent out property, don't you? You have a tenant, they pay you rent. You understand that. Shares. Renting shares. You mean you can rent out your shares and get income? Aha, yes, you get it. That makes sense? What it actually is, you're writing, jot this down, you're writing a covered call. If you knew nothing about this strategy, writing a covered call, you would go into trance. If I said to you, you're going to write a covered call, and then you might be buying some underlying put options to protect yourself, okay, most of you would go into a complete trance. Because once your mind hears more than one thing it doesn't know, two unknowns, it's like trance, shut down, equals pain, go back to my job, at least I know how to do that, okay? That's how our brain works, is that true? Okay, for some of you going through this, you've been shutting, this is too difficult, no, or maybe I can do it, it's too difficult, or maybe I can do it, just relax. Writing covered call. So writing means, so it's like learning another language. Why do they make it complex and difficult? My belief is so they can charge you money. Think about it. Why does a legal profession exist? It's like understanding a different language. So you have to pay someone to understand it. Accounting, to pay someone to understand it. Okay? Stockbrokers use different language. They sound sophisticated, whatever. Okay, so it's like learning another language. So writing is really, that is selling. A call is the rent. Call option is the rent, basically. Covered, what that means. So when you're selling, if you owned a property, you're selling the rent to the tenant. Does that make sense? You have the product and you're selling the rent. So in this case, you own the share, you're selling the rent. What covered means is that you actually own the underlying share because you can actually sell the rent and not actually own the stock. In this case, it's covered because you bought XYZ share. So it's covered by the share that you own. Make sense? So you're selling the rent over a share that you actually own. That's what it means. Make sense? So call options is renting shares. Make sense now? So when you look at the paper and you see the call options section, go, aha, I know what that is. Renting shares, this will tell me what the rental prices are for whatever share that I want to buy. Okay? Make it a lot easier for you. So the renting call options, let's say we're going to look at, say, Macquarie Bank. Okay? Macquarie Bank, is it a profitable company? Yes or no? Yes or no? Yeah, it's a very profitable company. It makes about $940 million a year. Okay? It's probably, last I heard, its expectations for the year ahead is slightly less or uncertain. That would explain why its share price has gone down. Do you know how Macquarie makes its money? Well, it's a bank. You know how they rip off people. You figured that out. No, Macquarie would be an interesting one because you might know how some divisions of Macquarie make money, but Macquarie suffered in the credit crisis because they have some divisions that were like Babcock and Brown or the investment banks in America that's quite complex and you're not really sure how they make their money. And Babcock and Brown, remember, wasn't making money, and they said they were, and they went under. Okay, so that really affected. So Macquarie is a little bit more of a complicated business. Does make money. Some divisions are simple, so you need to do a bit more research on Macquarie to really understand how they're making the money. The question is it undervalued? Well, what share price is it trading at? Do you see that? $23.95. So let's say it's making money, I can tell you that. You'd have to understand how it makes its money to have a judge of its future. And its share price is $23.95. So by looking at the high and low of the share price, say for the last 12 months, would help you identify, is it undervalued or overvalued? Okay, so the high and low, I don't think they tell you there, but the high and low you can look up on the ASX site, asx.com, or go to a lot of stockbroking sites. This information will be freely available. And at my guess, let's say the last 24 months, I'm guessing, Macquarie has been up to $101. It's been down to $17. Knowing that information now, does that help you give more of an understanding? Is it undervalued or overvalued? You could say, my God, if it's been up to $100, it's $23.95, it could potentially be undervalued. You do a little bit more homework and see why it's only valued at that at this point in time, okay? And there's market sentiment that's affecting Macquarie, and also its growth prospects are not as great as they used to be. It used to be called the Millionaire Factory. Investment banks are coming under pressure. They're looking at difficult times, and investment banks are sacking employers around the world, okay? Therefore, that would be putting downward pressure on its share price. What we're interested in, though, is one, if we're happy to own the stock and we're comfortable that it's worth that, then if we wanted to rent it out. So let's say for December. Now, if it's trading at $23.95, you'll generally rent it out above $23.95, and it's up to you where you rent it. At $24 in December, how much will you get paid in rent? So you have two columns. You have $1.10 and then $1. So if $1.10 is fair value and $1 is last sale. Okay? So let's just go on fair value. Okay? So fair value is $1.10. That means if you wanted to rent it out there, you could also rent it out at $25. See that? How much would you get for $25? 57 cents. Okay? So what that means, if you were to rent it for December for $24, okay, you get $1.10 in rent. If you had 1,000 shares of Macquarie, how much does that give you? $1,100. If you had 10,000 shares, how much does that give you? $11,000. If you had 20,000 shares, that would give you $22,000. Okay, let me change the perspective of this. If I said, I have a business for sale. Remember, you're buying a business. If I said I have a business for sale, and many Australians will borrow against their house to buy a business, could you spend $500,000 on a typical business in Australia easily? Like a restaurant, you could spend $500,000, a big news agency or something. So let's say you're in the market to buy a business for $500,000. Traditional business, you're probably going to have expertise, hire people, you have potential to lose money, you'll be working 6-7 days a week, a lot of stress, and your business, you pay $500,000 for it, say a restaurant, are you guaranteed you could get your money back in a year's time? Now, you mightn't get any buyer for it, or you could go broke in the meantime. So the risk is incredibly high, traditional business. A business like this, yes, there's risk to it, but look at the difference. If you were going to buy, let's say you had $500,000 to invest in a business. Now, in this case, if you didn't have $500,000 in cash, could you easily borrow at least 50% of this? I'll tell you now, almost anyone in this room could borrow at least 50% of this if you had the other. Through a what sort of loan? Margin loan. So let's say you can get $250,000 quite easily from a margin loan. That's going to be probably one of the easiest forms of finance you can get, even though it's a little bit more difficult than what it used to be. And let's say you had some equity in your house. Let's say you had $250,000 you could pull out of your house. So therefore, that's how you raise your $500,000. And you're going to buy a business. And you're in the market to buy a business. And I said to you, here I have a business. The business is Macquarie Bank. Your attraction to this business might be, folks, that you don't have to show up at work. Actually, in fact, if you buy this business, we will not let you in the building. You must stay at home. You must let us run it. We have management in place, professional management in place. We'll send you quarterly reports, and you can read about us in the paper how well we're doing. But you're not to come in. So people go, shit, that's good. I have to go on holiday then. Is that a good business to start with? You're not actually allowed to go. You can show up once a year to work to shareholders meeting, and pretty much we won't let you say much anyhow. So that's the deal. The deal is also the business, if you want to buy 20,000 shares, this business is going to cost you $24 a share. Currently, it's going to cost 20,000 shares. It'll cost you $480,000 the business is currently going for. We have finance available. Anyone in the room today, 50% finance, actually up to probably 70%, but generally we'll only go 50%. That's good. Most businesses, they won't give you 50% like that at pretty reasonable interest rates. This business, you'll need to spend about 30 minutes a month just checking on it, and you can generate an income of, it varies, maybe $10,000, $15,000, $20,000 a month. If you want to check our books for what you could have earned this year, you can see what they are. If you want to do it for December, if you buy this business now for December, what's in the marketplace you can rent out, the maximum you're going to earn is $1.10 at $24, and you're going to get $22,000 for the month. Raise your hand if that's of interest to you, $22,000 a month, we're going to give you 50% finance for it. By the way, it's a well-managed business. It's been in business for X amount of years. We're making $940 million profit. We do realize that we're coming into tough economic conditions and our profits may not be as great. However, we have the flexibility to sack staff, etc. You don't have to worry about that. We'll take care of that. Is that good business? If we look at it in comparison to what a lot of people risk their money on, there's a risk to everything, but all of a sudden it starts to become very attractive. Why? Because it gives you a cash flow without working, and you still own an asset. I mean, Macquarie Bank is that, I'm not saying, this is just an example, I'm not saying run out and buy Macquarie Bank, I'm just saying it's an example, but is Macquarie Bank still a substantial asset? Okay, you're still you're not buying some Babcock and Brown or some, AMP even, You're buying a pretty solid business that has a track record. Also, they could say this business in the past has been as valued as much as $101 a share. It's been valued 5 times as much as what it is. It's been up to as much as $2.5 million. So there's a possibility if we get our act together and the world changes, we may one day get back to being worth $2.5 million, which you outlay $500,000 for. But I must warn you, disclaimer, our business has dropped in the past as low as $17 a share. Therefore, your $500,000 asset at worst case has been down to $400,000. However, we will make you aware that you can actually take out insurance on your investment. That will cost you, but you can protect your investment. Plus, we must also make you aware we do pay dividends. I'm not going to tell you how much, but you can check our books for what we paid in the past. Make sense? So basically, you've done your research and go and do and say, do you want to buy that business? Knowing that you can borrow, you can insure and that sort of stuff. Who thinks it's a pretty reasonable offer as a business? Okay, not as in a concept at least. It's a significant potential. So compared to if I said, okay, I have a restaurant here in the Gold Coast, don't listen to what you read about in the paper. The Gold Coast is going really well. Strong economy. We've seen some customers walk by last week. We're confident some of them will come in next week. We're not going to give you any finance on the business, none whatsoever. Go speak to your bank, but you're wasting your time. This business has never been worth as much as $500,000. I'm just trying to flog it to you for that so I can get out of it because it's killing me. You can take over my staff, good luck. It's one of the reasons why I'm leaving. I haven't had a holiday in 3 years. I've got a lot more wrinkles than I used to have before I bought this business. If you ask me truthfully, would I ever invest in this? No friggin' way. But I'm not going to tell you that, and it's going to come with no disclaimers. If you buy this business within a week, it could be worth nothing. If you get sick of it, it doesn't matter. You won't get sick of it because you'll pay attention, because when it's losing you $20,000, $30,000 a week, you'll be paying attention. And then you'll be faced with writing off $500,000 investment that you couldn't borrow for, that's borrowed against your house. because it's losing you $30,000 a week. Who's excited? People sign up for that all day long in the hope of making money. So there is no guarantees in any investment, but you can see why a lot of smart people, wealthy people are aware of these strategies and consider it as part of their portfolio. The predominant reason why we're looking at a strategy like this is cash flow, because we know we can accumulate assets through real estate, but what we want is some cash flow to combine the two. So this works best if you do have a property portfolio for long-term capital growth and generating some revenue. That's what it's for. Out of all the strategies that have been consistent, this has certainly been a consistent one for a long period of time through all different sorts of markets. The returns you get can be affected by your individual ability. Therefore, the more educated you are, the more practice you do, the better you are at fine-tuning, the more experience you have in the market. But ultimately, the key to success comes down to using the Warren Buffett strategy of when you get into a stock, being into a good position. Make sense? So that's an example there. Now, there's another one there in the National Australia Bank. There's heaps of them there. Here's what your quick homework is to do now. You do this with your buddy. You have to assume you have $500,000 to invest in a business, and you decided to invest in a share renting business. However, you raise that money, you don't have to use the whole $500,000. You got $250,000 from your line of credit or wherever you got it from, and you got 50% margin loan. Now, before I give you your homework, you also have the option to insure your shares. How do you insure your shares? If you look on the fourth column, it says put options. What does it say? Put options. So to Tonga, put options simply means insurance. Make sense? Put options equals insurance premium. So when you see put options, you go, aha, insurance. Now I know what they're talking about. So this will tell you how much your insurance will cost. So you can insure your shares. Now, what I will tell you to do in this strategy, I call it wipeout insurance, or really what I call it, another technical name, it's called cheap insurance. What cheap insurance is, you're not going to insure it. Now, some people go, oh, I can insure my shares. Well, let's say you bought them at $23.95. You're not going to insure them at $23.95 because it's going to cost you the same you earn. It's pointless. You might insure them at, say, $15 as an example. It might cost you, I'm making up figures here, 10 cents. Okay, as an example. So it's cheap. What it does, it's wipe out insurance. It means if the market completely collapsed or Macquarie Bank for some reason went broke, highly unlikely, but black swan type event. But you're protected here, okay? So you're insured here, so you're protected here. You've made some money here, $1.10, maybe you're renting it for a few months, so you've made some money here, so you're minimized your worst case scenario. So some people say, well, why bother insurance? But it's a little bit like your house. Let's say you insure your house for 20 years and go, shit, it hasn't burnt down, I'm not going to insure it next year. That would be dumb, wouldn't it? So if you're borrowing money, I would make it as a must rule. It's up to you what you do. But have some cheap insurance, especially in volatile times. It also, I'm not going to cover it now, but when the market comes down and you have insurance, you can make money from that. So if you know how to ride these sort of volatilities, on the Homestudy, it talks about September 11th trade, that type thing, is that you can actually profit from that. It's a little bit more advanced, but you'll be in a position to profit from that. It's not that hard advanced, but once you're in the market, you know how to do that. Okay, I won't go into that right now because we want to confuse you. Let's stay with renting shares and just basic insurance to protect your downside. So your homework is, which you're going to do now, is you can actually insure your shares if you wish. But let's look at some cheap insurance on Macquarie. If you go put options Macquarie, now the difference with insurance must be, where is it? Macquarie down the bottom on the last column, Macquarie Group. With insurance, now with renting shares, you rent it out above the price you buy it at. Insurance, you're going to go the other way. Okay, that's the only difference. So remember, you want cheaper insurance. So if you go for December, if you want insurance, this doesn't tell you every trade. But if you insured it at, say, $18, how much is it going to cost you? 11 cents. Make sense? So instead of 15 at $18, 11 cents. Make sense? Now, what price? So, Jamie, what price should I rent it out? What price should I also insure it at? That is up to you. You're running the business, okay? It'll depend. You can pay more money and insure it here. It's up to you what you do. That's just a choice that you'll have. Okay? Okay, so with your buddy, quickly, $500,000 worth of shares. Choose which stock or stocks you're going to buy. You have 3 minutes to do this. You have to do it under pressure. Rent them out if you're going to insure them. And then what you're going to do, we're going to hear from some people what they did. And then you're going to check in at the end of December and see how you would have went. Go for it quickly. So at least 5 best things you've learned and 5 action steps and share with your buddy. Okay, let's hear down the back row over here. We'll start over here. Far away. What stock did you buy? So everyone write down, as we write this down, it'll give you get your head getting around the trades. Okay, what we're actually doing here is this is exactly the same as trading. You're paper trading now, okay, but you're effectively trading. Does it make sense? Because the only difference is when you go live is that, see, most live trading and paper trading, there's a big difference. In this, it's the same thing. You make a trade, you check in the end of the month how you would have went. Okay, then you do it again. So that's just assuming you actually made this trade. You'll be able to check in at the end of December or before, when the trading month ends before Christmas to see how you would have went. So you'll be able to quickly know how you would have went with this. Far away.
Yeah, I'm Kevin from Team 9.
Hi, Kevin.
NAB we chose.
NAB, yep.
The last sale was 24.30.
Okay, just quickly, does everyone know, is NAB profitable? Yes. Do you know how it makes its money? Yes. Is it overvalued or undervalued? Harder to tell. You could check out, what would you check out? Its high and low, what it's been to. On Monday, I'll teach you a little bit more how other things that you would pick up for. But if the overall market sentiment is down of the overall market, especially the banking sector, they had recent downgrades, the top 4 banks, that might affect it. I haven't checked the price in recent days. Probably won't affect them that much. But if the overall market sentiment is down with uncertainty in the market, a fair chance most stocks are undervalued. Okay? More likely, but you'd have to do a bit more research. But would you be comfortable owning NAB as a business?
Yes.
Yep. Okay, yep, fire away. How much was NAB?
Last sale was 24.34.
24.34. And you're doing this for December?
Yep.
And what did you rent it out at?
73 cents.
What price did you rent it at, sorry?
24.50.
So rented at 24.50 at how much? 77
73.
Cents? 73. And how many shares did you own?
We took 20,000 shares.
20,000 shares. So how much was that?
486,800.
For that?
486,800.
So shouldn't it be 14,600?
Oh, sorry. You asked me what. Okay.
Okay, so sorry.
14,600, yep.
Yeah, 14,600 is how much rent you got for the month. And you're saying how much you spent.
Yep.
Yeah, was what? 48,000 thereabouts.
Yep.
So you use up most of your money. So 14,600 in rent for the month. Who likes that as a business, by the way? NAB is a fairly stable, solid company that you own an asset in, and you can milk that sort of return out of. How aggressive is that? It's fairly close to the money. The other terminology that I didn't cover is at the money. Jot this down. At the money. Out of the money. Or in the money. At the money is what? At the money is 24.34. That's where the money is at. Out of the money is outside, or in other words, above the money. What is 24.50 out of the money? And in the money would be anything inside. That's the money inside that, underneath that. Making sense? So you'll hear those terminology. It doesn't really matter that much, but just so you know, you don't get confused when people say those things. So when I said it's fairly close to the money, fairly close to the price, that's considered fairly aggressive. In other words, what you mean is that NAB only has to rise slightly and you will be sold. But if you're not worried about that, you're getting good rental, you're just not going to get much more capital growth. You'll only get 16 cents thereabouts, less your fees, you're going to get bugger all extra capital growth, but you're still happy with this. Okay? Your other option was to go, okay, I might rent it out at $25 or $25.50. That's completely up to you how you do that. Okay? If you don't mind being sold, definitely you could do it there. Yep, so what else did you do? Did you insure it
Yeah, we insured it at $20 for 10 cents.
at $10?
$20,
You insured it at $20. How much did it cost you?
10 cents.
Wow. So that's cheap insurance. So that would have cost you how much?
$2,000.
$2,000. So your net was $12,600 before fees. And Andrew will cover what fees are roughly, but you know, on an actual options contract, you know, it's varied, depending if it's online or full service, 75, 80 bucks. Then you'll pay fees every time, obviously, you buy and sell. That will vary subject to how good a relationship you have with a stockbroker, what rates they'll give you. The more you trade, the better the rates, or whether it's online or whatever. But pretty much $12,600 now. Were you happy with that?
Yep. Then if we exercise, there was another $3,200.
Another $3,200 less your fees. Does everyone follow that? 73, that's for rental he got. Okay, so he rented out at $24.50 for December, 73 cents. He bought 20,000 shares. 20,000 shares times 73 cents equals $14,600 for the month. He then took out insurance. He insured at $20. Okay, it only cost him 10 cents a share, which is $2,000 for the 20,000 insured. Cost him $2,000. Okay, so it's got, take that off, he's net at $12,600 before brokerage. Give him a hand for that. Who's getting slightly more confident with the strategy? Starting to understand a little bit more? Okay, who's still confused? No, that's all right, you can watch the DVDs. Okay, I'll take one more example. Let's go over this side. What's your name? Chris? Let me guess, you're from Team 10? Who's actually winning? Team 10. Team 10. Fire away, Chris. What stock did you do?
Newcrest.
Newcrest. What's Newcrest do?
Mining.
So you know how it makes its money?
Yep.
And what price was it?
It was $36.62.
$36.62?
Yes. Yep.
And is it profitable?
Yep.
And do you think it's undervalued or overvalued? You think it's
Pretty happy,
undervalued?
yep.
Okay, so we could check the high and lows if we had time to do that, where it's been up to. And you knew, if you followed the stock or did some research, you could soon read about the company, you start to find out. So you rented it out for December at what price?
Yep. We went slightly against you. Went a little bit in the money at $36.50 for.
Okay, you can actually do that. So generally you won't. Okay, you'll generally rent it above what you bought it at. In this case, he's went in the money. You can actually do that. It simply means this: the shares will be sold. Okay. Which is okay, you probably don't care, because some people go, if I wanted to, obviously the market will change, but if I wanted to sell shares, sometimes it's a way to do that.
Yep. So $36.50 with a $1.30 call. We've sold insurance, so we bought a put at $34 with a premium of 30 cents.
So it costs you 30 cents insurance.
Yep, and once we factor in the fact that we'll lose when we sell the shares, we'll make a profit of $11,440.
So then here you got to factor in, you're going to lose at least 12 cents there.
12 cents, yep.
Plus your fees. Plus you're going to lose 30 cents in insurance. You're left with, what, 88 cents?
88 cents, yep. Which would give us a profit of $11,440.
You bought how many shares?
13,000.
13,000 shares.
Yep.
By the 88 cents is how much? Sorry, how much?
11,440.
440.
Yep.
Does everyone see that?
Well, if the share price does drop below, then say it drops to $1, for example, and it really shits itself, for lack of a better word, then whilst everyone would lose the whole $500,000, we'll still get $34 a share at our price.
Yep. Okay, so you see what he's done there? Okay. Now, some of you are querying about the insurance. You say, well, he's going to be exercised, so don't worry about the insurance. Okay. It's not necessarily, I mean, you can ask Backstat the technical questions, but there is a case where, there may be that, but that share price could drop quickly. Okay. Well, what was it, $36.50? You rented that out.
Yeah.
Yeah. So share prices can move quite quickly. So if you've done that, it could drop below $36.50 quickly. Okay. So the point is generally, so we don't want you confused, generally you're going to rent it out above the price. Okay. In this case, he's been a little bit cheeky, a little bit aggressive. okay? But don't worry about that for now. All you need to know is that you've got a rental price. If you insured it, you've got to deduct the insurance price. Just stick to that, okay? And you have a net price. So everyone get that? Okay? That one's a little bit more complicated, so... but he's just being creative. This, what you've been learning, renting shares, is certainly up there in probably the top 2 or 3 most successful investment strategies. And what you're about to hear from is a success story, a gentleman that started with renting shares and then quickly moved to selling insurance. And I haven't touched on the selling insurance yet because we're running through a lot of things, but just quickly, what you're about to hear a success story on is where it says put options. That's insurance premiums, right? We were talking about buying insurance, remember, to protect our positions. You can also actually sell insurance. Some of you are familiar with that, some of you aren't. Once again, it's terminology I created. You're selling put options. Now, this can be a very lucrative cash flow strategy. Once you've learned renting shares, it then makes a lot more sense. What we would then do, and what I've taught for many years, is that renting shares, you can adjust the strategy slightly and change it to selling insurance. The adjustment is this. When you rent shares, you outlay and buy the share, and then you rent it out. In selling insurance, you can sell the insurance without owning the share, right? So you simply make a promise to say, let's say, if we go back to Macquarie as an example. Remember we said Macquarie was $23.95 and we were going to rent it out for $1.10 as an example, okay? And we could get, I think, $22,000 for the month, okay? So this is Macquarie, we rent it out. If you wanted to, instead of buying Macquarie at $23.95, you could look in the put options section for Macquarie for December, wherever it is, down the bottom of the last line. And if you look around December, around $24, okay, $1.07 or 23.75 cents, okay? So what it effectively means is that you can make a promise. Now, when you're with insurance, in renting shares, when you make that promise or to rent out your shares, you generally go above the price that you rented out. When selling insurance, with insurance, you'll go the opposite way generally, okay? So let's just say $24 for the sake of arguments, okay, because it's close to $24. You would get $1.07. Does that make sense? So if you look at Macquarie, December, $24, fair value, $1.07. What that means is that you can make a promise, instead of buying the stock, you can make the promise to buy it in December at $24 and get $1.07, pretty much the same money, without actually having to buy the stock. Who likes the idea of that, by the way, just from what you heard so far? So now, without actually buying the stock, simply by saying, are you saying, Jamie, that I can simply make a promise and say, I'm happy to buy BHP at $24 because I was about to buy it anyhow. I've done my research. I'm happy to buy it at $24. But I don't have to. I can simply say to the market, I promise to buy it at $24 in December or any time up until the 16th of December when the contracts end. And they will pay me $1.07 per share that I make that promise on into my bank account. Is that for real? Absolutely. You can do that. Many people don't realize that. Now, here's the interesting thing, is this strategy can work very well if you understand fundamentals and doing it over stock you're comfortable owning. If you're prepared to buy this stock and rent it out, it's no different than are you prepared to buy the stock by making a promise. The only difference is when you make a promise for December, this stock price can move up and down in December. You're making a promise now, by come mid-December, it could have dropped down, but you still have to pay $24 for it. Does that make sense? But you still receive this money, okay? But that doesn't make any difference because if you had bought it now for $24 and it drops down during mid-December, the same thing would have happened anyhow. You would have had a stock that dropped down. So you see what you're doing? So all you're doing is slightly adjusting the strategy. Instead of buying to rent out, you're simply making the promise to sell the insurance. And let's say the come the end of December when the contract runs out, the share price is above 24, okay, you don't have to buy. So next month you can make a promise to buy it again and again until eventually you might get what? Exercise and you have to buy the stock, but you're prepared to buy the stock anyhow. So this strategy works well if you've done your homework on the stock and you're prepared to buy the stock anyhow. But then what you can do is do in a strategy where you don't ever intend buying the stock. You see, we start to get a little bit more complicated. So I don't want to touch on that right now because, let's just get our head around what we're doing. But they're things that you can learn more. Does that sound exciting? It's exciting if done correctly. Well, of course, because you still insure your positions. You still do the same thing with insurance. So you have the cheap insurance to protect your position. All you've done instead of buy the stock and rent it out at $1.10, you've said, okay, I'm going to buy the stock, I make a promise to buy it, and I get $1. It's pretty much the same money. Sounds too good to be true. But in life, we want to check out the facts because we don't want to miss a good opportunity. The gentleman you're about to hear from, we're very fortunate that he's actually on the Gold Coast at the moment. It wasn't planned, but he happened to be here on some business and perhaps a holiday. And we asked him to drop in to say hi to you. This particular gentleman, 21st Century member from 4 years ago. We'll ask him some questions, he'll share his story. But he's had amazing success, making $40,000 to $50,000 a month using these strategies, initially of renting shares and then moving to this selling insurance strategy. Who would be excited to learn off someone that's in real life that's making that sort of money? Okay, can you please help me give a very warm 21st century welcome to Mr. John Thompson. Grab a seat. Well, John, it's good to have you back. I know you're a busy man. You live in Perth, that's right?
That's right, yeah.
Yeah, all the way over there.
Yes.
So going back in history, and it seems that, obviously we've spoken a few times and interviewed you in the past, but was it 4 or 5 years ago you become a 21st century member?
Yeah, about 4 years, I think. I might have lost track of time a bit at my age.
So 4 or 5 years ago, before that, so obviously you started with the 20th Century Homestudy, watching the DVDs.
Right, yeah.
Yep. And before that, had you ever actually been a stock market trader or done much before?
The only thing I had done was buy Telstra One, put in a few $1,000 and bought some Telstra shares and sold them when they went up to $7 and didn't go into Telstra 2, which is a good move.
So you're one of the few people that still talk to John Howard, probably. Yeah. So that's amazing. You had no real trading experience. So you then obviously come to a 4-day event just like this. Is it true?
That's
back
right,
in Perth, back 4 years ago.
Yeah.
And you're someone that took action obviously fairly quickly. Obviously, you started true with the renting shares initially.
Yeah, yeah.
And how did you go, say, when you first started?
Well, I wrote, my first trade was 3 covered calls and 2 naked puts. I happened to have some shares and I wrote those options and I made $3,500.
Wow. Give him a hand for that, by the way. And you did that pretty much in a week after...
And I just paid $3,000 for the program, by the way.
So you got your money back for the program pretty much...
In a week.
In a week.
But that's a bit of that was, I don't know, it just, you could call it luck, but I just came in at that time. I saw the strategy, was convinced, and did it. Flying by the seat of my pants.
So you can see in the psychology there the difference in what John obviously well said as far as you took action. Is it the smart thing is when you're trying a new strategies, obviously it comes down to at some point you have to do it. You can paper trade for a little while and practice. Then eventually, should you put your whole house on it or should you just start small, perhaps like John did? The obvious answer, we should start small. So obviously, what did you do the second month? What happened after that? So.
Well, I just kept doing the same thing. And then I quickly decided that naked puts were better than covered calls.
So what John's talking about there is selling insurance. When he talks about naked puts, the word for that, selling insurance. So you know what we're talking about there. So it's something that we do often. People start with renting shares, and then if they want, they can take out what we just did there and sell the insurance, or then go back. When you buy the share, then you rent it out. Or in this case, John's amended the strategy where he never intended to buy the share. So how long did it, obviously the story is quite famous for a lot of people now that have heard your story, John, how you then, over a period of time, took your investment results up to making like $40,000 a month and more. How long was that journey from when you were at that 4-day in Perth?
It took me 2 years.
2 years.
And so I started out with $10,000, and I had to put in more capital because I wanted to... See, what you do, it's a mathematical equation. The percentage you get times your capital, that's your return. So if you want to make a lot of money, you've got to build your capital up. So that's what I concentrated on. And I took $100,000 out of a mortgage and put it in. And then I sold a unit. And I put a small part of that proceeds into the trading. And I went from, progressively $10,000 a month, 15, 20. And after 2 years I was doing, because it's a mathematical equation, I had the capital out, I was getting 40,000, and I maintained that.
Give me a hand for that, by the way. I'm just curious, anyone here that would be excited within 2 years from now that you're up to the level of making $40,000 a month? Who thinks that would be a pretty good outcome? Most people would be like, my God, he's probably cashed out at $20,000 a month and gone on a holiday. Okay, so what, obviously, I mean, that's pretty exciting. I mean, I've heard before that your wife had something to do with a bit of a nudge to get you to perform even higher levels. Is that true?
Nothing like a wife to gouge you into... She'd hate me for saying that because she doesn't do that. But, I mean, if your wife challenges you for something, with something, and tells you can't do it, that's the best incentive you can get to succeed. And see what happened, at that time, I was making about $6,000 a month. And I was I was making more than that. I was making $6,000 a week. $6,000 a week. And I suddenly came to the realisation that with this strategy I can make whatever I want if I get the capital up. And she laughed at me. Oh, yes. And I said, well, what do you want? She said, $10,000 a week. And it took me that long to decide I can do it. All I had to do, that's when I put more capital in, and I immediately got her $10,000 a week. So that's how you do it, boys.
So, John, if I hear you correctly, are you saying that the key to success, your success, is have a very expensive wife?
My wife isn't. They've broken the mould. She's not expensive. She's very frugal, supports me with everything. The key to success, have a partner who supports you, and you'll do, 2 people will do 10 times what one can do alone.
That's quite inspiring. So, John, why do you think perhaps you've been maybe more successful than, say, other people who haven't had your level of success? Why do you think you've outperformed other people?
I've been asked that question before, and the first time I heard it, I thought, well, why? Now, what I do is all mindset. See, the difference between Jamie McIntyre and you is his mindset and the way he thinks about money and everything he does. So you just have to develop and hone your mindset, and you can make as much as Jamie. Now,
Thanks,
I
John.
use mindset for everything I do with my trading. And I learnt that from listening to Jamie.
Yeah.
Just sitting in there with you. And I know. See, and the answer to your question is that all my life I've had a natural mindset. everyone's got a mindset, but I'd never heard the word mindset. And that's the answer to the question. I've succeeded because I had mindset and I used it. So...
Yeah, that's very important. So, and obviously we teach that, obviously you would have been taught as well, 80% is psychology, mindset, 20% is the actual strategy. And you'd know as well, I mean, any top trader that I've spoken to, they all will remind people about the psychology. A new trader is like, yeah, just show me the money. As human psychology, just show me the strategy and I'll do that. And then they usually figure out the hard way the distinction and the importance of mindset. But true, part of that mindset also is taking action and learning as we go. So obviously $40,000, $50,000 a month type stuff, that's about $500,000 trading bank or capital.
The calculation of $40,000 a month was made at me having 500,000 and getting 8%. I've never had 500,000 actual of my money in the bank, being employed. When that figure was established, I actually had 350,000. I think that was the figure, round about that.
So what's John saying is $500,000 available, and he was using 350,000.
No, I only had 300.
Oh, you only had 350,
Had that. So I was.
So you built your capital out after that, yeah.
I was actually getting better than 8%, but at that point, I'm just learning this thing, and I wasn't concentrating on a percentage. All I did was, I'm only in the game for a short while, and all I concentrated on was my bottom line. Have I got more money at the end of this month than I had last month? Yeah. The answer is yes, so I was happy. And I didn't care whether it was 8% or 10% or what. I don't believe in concentrating on a percentage. I believe in concentrating on having winning trades. And preferably with small, safe percentages.
So now what we're getting into is some of the, without going into too much detail, I know we've spoken before about this, and I've looked at John to say, well, okay, what's John doing slightly different to increase his returns and do so well? And one of those distinctions that we discovered is that you're doing on your trading bank, instead of doing one gigantic trade on one particular stock, you're doing a multitude of stocks across a multitude of industries. So in that case, John's not doing one big trade where he's like, shit, I hope this goes the right way, and has that mental pressure of getting him out of state or affecting his mindset. John has been doing small trades, even as his portfolio has grown, but small trades where large majority of them are successful trades, true?
Yeah, absolutely.
And as a result of that, John's confidence continually got better and better, because let's say 8 out of every 10 or 9 out of every 10 trades you do, you're winning. Will that build your self-confidence, yes or no? Will that strengthen your psychology? Rather than one big trade and if it goes flat, then you're out of the game. So that was part of the strategy, I think, because you also diversified across multiple companies, across multiple industries. I think that was a critical distinction.
Diversification is the most important thing that you can use to succeed in trading, because, as Jamie said, if you've got 8 or 9 wins and 1 loss, provided they're evenly constructed, it's no good having an aggressive trade that goes wrong, and that might destroy 4 or 5 of your winning trades. If they're evenly balanced, you can't lose. You'll lose some money. In other words, if you have 8, say it's 8, and you win 1,000 on each one, and then you have 2 that lose, and because they're losers, you might lose 2,000. Well, you're still 2 times 2 is 4. You're still 4,000 up.
So it's a very good distinction. So obviously when you would say, well, the one question I think you did answer before, but some people say, well, John, to get started in this particular strategy, what's the minimum amount you probably need, or what did you start with?
10,000. I was challenged recently and was told you can't do this strategy without 100,000. And I can tell you, you can do it with 5. But if you've only got 5,000, remember our equation, you can't get a big return in monetary terms, but you'll get exactly the same percentage as I get. And then that gives you the incentive to build up your capital.
So if someone say, they don't say, well, I don't have $350,000 or $500,000 in capital, but if they had, say, $50,000 in capital, being 10% of the portfolio that you build up, and you're making, say, $40,000 a month, that's what you're saying. If they got, 10% of that, $4,000 a month on a, $40,000, $50,000 capital bank is extraordinarily successful, of getting that same return as you. But even if they got half the return as you,
Yeah. See, my advice to everybody is to start small and win small. And then if you win, you can't retire. And if you lose, it's not going to hurt you. But you're learning the strategy, and you're learning to have confidence. See, I can tell you something, but until you do it yourself and experience it, you are not going to know it in here. But once you've done it over and over, like you were saying before, you do it over and win and win and win. From the knowledge you gain, you get the confidence, and then you're away.
So would you say, which is, I think is the point, so you basically, obviously, getting started is probably the most important step for people, isn't it? Actually to do a trade. A lot of people talk about what they're going to do and might read a book on it or watch a DVD, but if they never actually get out there and have a go, they're never ever going to progress to the level that you progress to.
Right. Yeah. See, I went in and I saw the DVDs and saw the principle, and the first week I went in, I did it. I've done that all my life. Just have a go. And you calculate the risk. And I wasn't going to... If you're trading, if you're doing it in a small way and you lose, it's no big deal. You learn more from the mistakes you might have made or whatever happened.
So the final question might be, what would you say to people that say, I'm too old to learn about investing?
I'd look at you and smile. Why wouldn't I? I was 72 when I started. So you can teach old dogs new tricks sometimes.
That's good to hear. So plans for the future? Obviously, it's just something that you're passionate about. You enjoy trading, and
yes, I just want to continue. Look, I'm honing what I'm doing. So what I've been doing in what we call a normal market, it's friendly market, it's easy to succeed. In this market that we've had over the last 3 months, it's not so easy. So I've had to adapt. And I've developed 2 lovely little strategies which take care of the 2 principal problems of a volatile market.
Yeah. So you're saying you never stop learning, and obviously as you continue to be, and obviously volatility we know can make it a bit of a roller coaster ride, but also can increase our potential profits.
It does, yeah. Without volatility, there would be no market. If shares just remain, people wouldn't buy shares or sell shares, and they wouldn't do buy or sell options because there's no point in it. So you've got to have volatility, but you've got to control the volatility. And it can be done quite simply.
Well, we'll take... does anyone have any questions they'd like to ask John? We might have 30 seconds for a quick question. We might take 1 or 2 quick questions. Let's start right over with Leanne at the back there. We've got to do this quick because we're a little bit behind time, and we've got to get Baxter up here to answer your questions on the share renting before we go for dinner. Fire away.
John, I just wanted to ask you about those things that you've used to sort of deal with the volatility of the market. I write naked put options as well, about 15% out of the money, 15 to 20% out of the money. And I just wondered if you write out of the money and what you've used to negotiate that volatility.
Yes, that and much more. Jamie said we've got a few minutes and it would take me half an hour.
Yeah, so it's a very good question, and what John will stick around briefly before he goes. You might get a chance to answer that one-on-one, but it might confuse people that are starting out, but there's a bit of depth to that question, but it is a good question. Is a really simple question? Anyone wants to ask a simple question? We'll start here with something that's simple.
Michael, stock selection. How do you pick your stocks?
Stock selection. My experience when I started, I bought recommendations from Daniel Kircher, and I kept a record in my head and on paper of those recommendations. Now, you can the money you pay for recommendations, I was paying $1,100 a year for the recommendations, produced by experts every weekend on the Monday. They'd come out and they would select one, maybe, or two that week and recommend them. And I was paying $1,100 for 12-month subscription and making $5,000 a trade.
So what you're saying, investing, obviously, because it saves time.
Yeah, saves time. You're paying $1,100 a year, and a very small trade, you make $1,000.
Yep.
And you might do 5 of those in one night.
Return on investment. So that's important. Stock selection is critical, and there's one way you can pay for different recommended services. We're out of time. John might stick around one-on-one for a few questions. John, I appreciate your time. It's good to have you back. Give him a big hand.